Well, the market ends with gains for the second straight week over positive global cues as Israel and Iran announce a ceasefire. That continues to hold as well. Well, the Sensex and the Nifty were up close to around 2% apiece this week, while the Nifty Bank continues to set all-time highs. Broader markets as well have outperformed. The Nifty Small Cap Index rose close to 4% this week. Hello and welcome to a brand new edition of Editors Roundtable. I'm Nigel, and with me the editors, Nimesh as well as Mangalam. And we have Gautam Dugar as well of Motilal Oswal who joins us in the studio today. Hi, gentlemen. All boys club.
All boys club.
All boys club today. And
a couple of them are teetotalers. So barring you, I guess we can't even talk about or celebrate.
we can talk about everything, like Gautam said as well, right? You can talk about whatever you want.
Yeah.
But that's all.
but good mood, right? Good mood. I mean, we are in great mood, obviously, because it's the end of the week.
Good momentum.
Good momentum. Markets are feeling good, Gautam. What kind of feedback are you getting? You throw bad news, and that's the perfect indication to allocate money. I think if we miss some of these bad news, then you'll wonder what to do. But otherwise, all dips are getting bought into.
Yeah, absolutely, Nigel. I mean, look, so much was thrown at this market.
Yeah.
Geopolitics, crude, 78, 80. Every alternate day, you're getting some news on the global front. Some war or other is happening. Earnings were also, after a long time, we have seen a good earnings in fourth quarter. Very good quality of earnings we have seen. Spread, depth, absolute quantum of earnings were great. But market, as they say, always climb the wall of worry. Yeah. And that is what is in demonstration in front of you in the last 15, 20 days. I mean, if you had told me a week back when this war started that after a week we will hit 25,600 and we'll be just 4 or 5% away from the all-time highs, I don't think anyone would have believed. So I think this market is giving you indication that a lot of things on the underlying basis are improving. Macro is great. Macro has been great for last 7-8 months. You look at the growth, you look at the inflation, currency has come back, your forex reserves are at all-time high, and RBI has reduced the inflation projections for the year. Right? On top of that, your twin deficits are under control. Very rarely I have seen such a strong macro backdrop for India in the last 10, 15 years. On top of that, what was missing was earnings for last year, and now that earnings is coming back.
Sure.
So market is feeling good, I think, because next 2 years, if we see 12-15% earnings growth, then the room for wealth creation from here also is tremendous.
But Gautam, you rightly put out the points on the India macro, and they're looking very strong. But look at all markets globally, right? The US S&P is back to its near all-time high. The Israel market is an all-time high. So is India. So are the other markets as well. But at the same time, the gold is again at a record high. Normally, we've not seen gold going up, crude going up, equity going up, bundles going up. So from that perspective, what is that the markets is missing out from a global perspective? The gold is higher. Crude, of course, has fallen this week because of the whatever geopolitical news. But largely, how are you mapping up the global stuff?
See, look, I'm not an expert on gold. All I know is that central banks have been buying a lot of gold in the last 4-5 years. In the last 3 years, gold has had a tremendous run. And if you look at the movement of gold prices over the last 40-50 years, gold goes through this spurt of huge moments in 2-3 years, then lies flat for 3-4 years. We've seen gold doing nothing for 5 years between 2012 to 2017, even in rupee terms, despite the import duties going up, and dollar prices were down 20-25%. So don't be surprised if in the next few years you don't get much returns from the gold. I'm not predicting it. I don't understand gold much. I just take mark to market whatever the commodity prices are. But to your other point, very rarely you would have seen, maybe first time, that the 10-year yield difference between US and India is at its lowest in last 20 years. Yeah. What does that tell you? That tells you that macroeconomic fundamentals of India are very strong and robust and resilient. And the predictability of those macroeconomic fundamentals is at its best right now. 4% inflation, when was the last time you saw projections like that? I mean, we have forgotten 10 years back, WPI used to be in 10-12%.
Yes.
CPI was 8-9%.
What you rightly pointed out, the predictability of macros, the earnings and everything is what giving a lot of confidence to the investors.
That's giving the premium as well. So the word that I use to describe the way this market has gone, and coincidentally, is the English word called juggernaut, which was derived from Jagannath Rath Yatra, because the meaning of Juggernaut means a force that continues to move on.
Propel it.
And that's exactly what the Rath Yatra is as well. So that's the kind of market that we're currently in. If gold prices are supposed to stay stable for the next 4 or 5 years, that'll be great news for consumers, because they've been pushing off their purchases because of higher gold prices. And in turn, some of these gold companies as well, say Titan and all these players.
Absolutely. Look at it two ways. Gold prices, the Indians hold 24 to 25,000 tons of gold in their households. The kind of massive wealth effect it creates, and then the kind of tailwinds it creates for household consumption is something which is under-researched and under-debated, in my view, because we have rarely discussed the total wealth which is sitting in the household balance sheets in the form of gold. Because we don't know. Even this 25,000 tons estimates are very random right now. There is no precise estimate about it. Second, as Mangalam pointed out, gold prices going up in a steady manner is the best possible scenario for jewelry companies.
Sure.
Elevated volatility in gold prices is something which is not very conducive for jewelry companies, because then demand takes a hit. People postpone their purchases. What we have seen in the last 2 years is massive increase in gold prices, which has dampened the demand to an extent. And like with any commodity, the price impact is much higher on the underlying earnings than the volume impact. Whether you take metals, whether you take cigarettes, whether you take steel, whether you take gold. In commodity-driven, P&Ls, and gold is a commodity end of the day, price impact creates a very disproportionate impact on underlying EPS rather than volume impact. So 1% price increase may increase your EPS by 4 to 5%, because it's a pass-through for most of these companies. They charge, making charges the percentage of underlying gold prices. But look at the same thing from a lens of 5 to 10 years. Every year you consume 800 tons of gold roughly. 550, 600 tons get consumed in wedding demand, and rest is all adornment and gifting and all. So the demographics that we are sitting on in India, youth demography, weddings are going to happen for next 10, 20 years. And it's a $80 billion industry, out of which only 40% is organized yet. So whoever has a steady balance sheet and good brand, I'm not talking about Titan, it's obviously the benchmark player, but other non-Titan jewelry companies also have a very flourishing future in my view.
Okay, all right. Well, let's do a quick recap first of what went on during the week, and then in fact we'll continue with the show. Well, it was a good week actually for the bulls. The Nifty went home with good gains. The question is, how soon do we get to those fresh all-time highs? Because the Nifty Bank is making fresh all-time highs almost on a day-to-day basis. July as well traditionally has been a good series for the Nifty. So we ended the June series on a high. And July series, 90% of the last 10 years, we have gone home with gains, which is good. And on the Nifty Bank, 70% of the last 10 years, we have gone home with gains. So the bulls will say, well, we have got this covered. All-time highs is what we can see, which is just around 2.5% away for the Nifty. The good news is a lot of these large cap names, Reliance Industries, HDFC Bank, they went through a period of underperformance. They seem to be getting their form back and in style. Remember, these stocks have bounced back big time in the last 6 months or so, and they are leading the way. The Nifty IT index, we have the NASDAQ that's at all-time highs. The Nifty as well is close to all-time highs, but the index that's furthest away from all-time highs is the IT index. That's 15% away. So a bit of catch-up, if that plays out, that will be the idea, because you have, the opening batsmen that are doing well, the one down as well, if it supports, then the markets will even go higher. And the macro tailwind is that crude oil prices have cooled off. Good for pain stocks. We have a big pain deal that was announced out there. Mangalam will tell us about that a little bit more. OMCs are seeing a lot of delivery-based buying, because now you have state elections that are a few months away. Crude oil prices have come in lower, and also valuations are fairly attractive. So those stocks are on the radar. Two big cues to track. One is what's going to happen on tariffs. The 90-day cool-off period ends on July 8th. Hopefully, President Trump doesn't have a negative surprise, and he's seen what happens in the past, so hopefully he doesn't go down that road. And the second factor is earnings. So that's going to be important to track. And Nimesh, on a day-to-day basis, has been telling us so much of supply that's coming in there.
That's getting over.
Now that is getting over.
Yeah.
So can we see the broader markets outperform even more from here on? Because that's supply overhang. Everyone's talking about 26,000 crores SIPs and the likes. You're having $1 billion being sold every day. And if this gets out of the system, maybe in fact the broader markets as well will feel good. So good times for the markets. But Mangalam, you track a lot of sporting events, the markets, films, everything. But one disappointment this week was? What was
the
that
India loss against England. I mean,
we were optimistic, but anyway.
I think, the young brigade will take it forward. They learn. And unfortunately, Bumrah is not playing the second game. That's what reports are suggesting.
Really?
So let's see how that happens as well. But whether Bumrah plays or not, the game is the capital market game itself. The news that we got on Friday, that Reliance has gone ahead, Jio Financial actually gone ahead and gotten a brokerage license as well. Do you think that is going to disrupt the other listed capital market players? Could this be a Jio moment for a lot of the brokers, etc.?
So I have a vested interest, obviously.
No, I understand.
Ample disclosures in place. I think, broking industry is already well disrupted. In the last 5-6 years, the kind of disruption you have seen from the discount broking players, I don't think anyone is afraid of whoever is coming or not coming, right? Look at the positives, 5 years back, exact 5 years back, when COVID just began in March 2020, we had 4 crore or 5 crore demat accounts. Today, as we sit, there are 20 crore demat accounts. our in-house view is that in the next 3 to 5 years, you will have 30 crore demat accounts. So equity penetration is just about beginning. You look at mutual fund AUM, it is still 1/3 of the bank deposits, and that after 10, 15, 12 years of a continuous increase. I'll give you a data point. 12 years back, when I joined my current organization, August 2012, rather 13 years back, the total equity AUM of mutual fund industry of India was 2 lakh crores. Wow. Today it is 36 lakh crores. Yeah. And today there are at least 8 to 9 mutual fund houses who are individually managing more than 2 lakh crores. In fact, there are schemes which are running into 80,000-90,000 crores now.
One scheme which is having an AUM of 1 lakh crores.
Yeah. So the kind of opportunity that we are sitting in, this industry can absorb much more number of players. And like I was discussing with Nimesh before the show, I mean, it's not just broking. I mean, the whole capital market ecosystem, the AMCs, the exchanges, the brokers, and then there are so many intermediaries. So the kind of money that can be made in that space over the next 5 to 10 years, in fact, as a house, we've been very bullish. We cover the maximum number of all listed stock in the capital market space.
Which is why the question was directed to
you. Yeah, we put out a report in December 24. So we think there is a lot of room for wealth creation there. In a traditional BFSI segment, historically, we've always discussed banks. Then 5-6 years back, NBFC started becoming more relevant. Then 3-4 years back, when a lot of insurance companies got listed, we started discussing insurance. Today, I think that moment is for the capital market players. And the sizes will become big. A lot of capital market-oriented theme funds will also be launched in this industry in the next 3 to 5 years.
Gautam, we'll discuss the capital market theme in details. But, first, the big story of the week was the big M&A that got announced in the paint sector. Mangalam, no better than you to explain what it means for JSW and what it actually means for the paint industry as well.
We're speaking about the disruption in the capital market space and whether there is space for everyone here or not. There is definitely disruption in the paints industry that took place, and whether there is space for everyone else or not is something that we're discussing. A 9,000 crore deal that has happened, JSW Paints has gone ahead and acquired AkzoNobel. So I'll just, first up, tell you the industry, what the players are doing and what the prognosis for the industry is as well. So let's start with, JSW Paints acquiring AkzoNobel at close to around 2,700 rupees per share for the promoter stake. 3,417 rupees per share is what they've allowed for an open offer as well. But on AkzoNobel, they're the 4th largest paint company in India. They're the makers of Dulux paints, and nearly 35% of their revenue comes in from decorative business as well. They have a high market share in the premium end of segment. Whereas JSW Paints, if you look at it, they've been in the market for over 6 years. FY24 is when they crossed that 2,000 crore revenue mark. FY25, they had a target of 3,000 crores. In FY26, 5,000 crores. All of this organically. Remember, 60% of their revenue comes in from intergroup business. So that's something we'll have to talk. If you look at the paint industry, the top 2 players have over 50% market share. Asian Paints last year did over 34,000 crores in terms of revenue. Berger, 11,500 crores. Kansai, 7,800 crores. AkzoNobel stands in here. Add another 2,000 crores of JSW Paints. It becomes a 6,000 crore player on the whole. The paint industry worth nearly 80,000 crores right now. 65,000 crores is organized, expected to grow anywhere between 12 to 13%, with the market share of top 2 players being over 50%, and that's what the conglomerates are eyeing. What is it that helps in, the business to grow? Birla Opus launched last year itself. They have high single-digit market cap and market share rather, and 900 to 1,200 crore in terms of quarterly run rate. Can they continue this business or not? They have a stated target of 10,000 crores in terms of revenue and EBITDA break-even by year 3 of complete operations. What is it that the incumbents will need to do? Focus on distribution, brand, tinting machines, and capacity. Capacity, the least of them all. First 3 is most important. What everyone will be looking at, how the incumbents and disruptors expand, whether there would be margin contraction in the industry or not, and eventually valuation multiples. Are we likely to see another derating once this disruption comes by or not? All of that depends on what AkzoNobel and JSW together do. We'll be tracking growth for JSW Paints along with AkzoNobel, x their own group revenues. Secondly, how much more will they invest in capacity, branding and distribution? And thirdly, from a listed company standpoint, will they list JSW Paints business via reverse merger, or will there be an IPO for JSW Paints itself or not? Paint stocks have seen a correction of almost 30-35% from the peak. Asian Paints at some point was trading over 60 times, now at 45 times. Berger Paints 40 times. So there has been one leg of valuation multiple derating that has taken place. Will there be more or not? And that exactly is the question to Gautam. Gautam, the demand environment is improving. We're also seeing some sort of improvement when it comes to cost tailwinds. The companies have gone ahead and seen one round of competition. JSW and Akzo have been around, so it's not that competition is any old right now, any new for them. Do you think paint companies are better off now than what they were, say, about a year and a half ago?
Yeah, so they're better off than what they were a year and a half ago. Obviously, as you pointed out, valuation multiples have also derated, but they're not cheap by any means of imagination. Even today, after 5 years of massive underperformance, they're still trading at 40-45 times. And when you have 2-3 big players entering an industry, we have seen this example in multiple other industries, that even if your business continues to do well, market tends to become a bit more cautious on the visibility of those returns, on the visibility of those margins.
So the PE gets contracted.
Yeah, so PE contraction happens. It's already underway. In the last 5 years, if you see, Asian Paints PE has contracted from 70 to somewhere about 45. Now, obviously, the growth has also shrunk. The premiumization, which was underway till 2020, 2021, has become actually a reverse trend. The putty and lower end paints have started outselling the distemper and other enamels and all. So we as a house don't have a very sanguine view right now on paints. In fact, many of the hallowed consumer companies, we don't have a very positive view there, because the growth has become a casualty for one or the other reason. You look at consumer staples or paints, the growth has hardly been there for the last 3-4 years. In fact, I was just telling Nimesh that a company like Hindustan Lever, right after the GSK deal, they announced, I think, the GSK acquisition somewhere in December 2018. Yeah. And then March 20, that big block happened of 35,000 crores. Point-to-point returns, if you look at, between June 2020 to June 2025, it's zero. Yeah. Nifty has given you 20% compounding, right? Even today, as we speak, the expectations for next 2 years for some of these companies are maximum 8 to 10% growth. Now, obviously, there could be some contra-buying which can be done because the sectors underperform. But somebody who's looking for growth investing in consumption, I think consumer discretionary offers a far better choice. And there are so many subsegments which have evolved in consumer discretionary in the last 10 years that you can have your own picking. There is jewelry, there is hotels, there is apparel, there are so many other subsegments. And there the growth is far better. And the other point which basically intersects with this is that the lower end consumption is still struggling for a variety of reasons. You will get 20 reasons if you ask 20 people. But the point is lower end consumption has been a big problem in India for last 3 years. You look at the volume growth of all these companies, barring 1 or 2 companies, they have not done well. And it's not a short-term problem, actually.
And the upper end is being eaten away by a lot of the premium players.
Absolutely. But Mangalam, that's like a new excuse.
Yes.
But you look at the last 10 years growth. Sure. Doing this exercise. Take last 10 years revenue growth of all consumer staple companies. There's not a single consumer staple company in India in the last 10 years which has given you 10% top line CAGR. Oh. I'm talking about top line, not volume.
Yes.
So you add volume plus price increase and still you don't get 10%. So this companies 5 years back were trading at 60-70 Ps. So those Ps have shrunk. Obviously, given the defensive nature of the businesses, the stock prices will not fall 30-40%, but they will time correct. And it will cost you huge opportunity loss. So if against Nifty you underperform 20%, against other sectors you might have ended up underperforming by 30-35%. Because Nifty 500 has given you 23% CAGR. Mid and small cap has given you 30-34% CAGR in the last 5 years. Because the earnings growth has kept pace. Nifty 500 profit pool has gone from 4 lakh crore to 16 lakh crores. Yeah. 4.7 to 15.7 lakh crores in last 5 years, which is a compounding of 30%. And the index has also given you 23% compounding.
And just to put that into perspective, 30% missing compounding for 5 years is a difference of 1 and 4. So something that has been compounding for 30% over 4 years becomes 4x.
Gautam is not interested in Mangalam. Paints and FMCG is making it clear there are better opportunities out there. You take a back seat for now. I'll tell you what. Let's take that short break. Gautam briefly mentioned about capital markets. So we'll continue that discussion. Nimesh has put together a very exciting piece. Don't go anywhere.